Hello y'all, my name is Ben Blanks with Three Rivers Mortgages. We're a division of Hamilton Group Funding out of Florida. I'm here to educate you on a few things I think they're going to help you in the process of getting your clients from the time they write the contract to the time you close and pick up your check. Now we're going to start with some things that I think are going to help you with your clients in the financing and the things you can do to maybe educate them a little bit in the process before they actually come meet the lender. That being said, it's just an overview. You're not the lender, and you don't need to be the lender or have any detailed information or answers for them. What you need to do is give them a broad overview of what to expect on the mortgage process. All this being said, I want everybody to understand, I've never heard of a mortgage emergency. I've never seen an ambulance going down the road saying mortgage emergency. What I have seen is procrastination, lack of communication, which causes frustration, and that's why most people miss closings. So as we talk about the financing options and the things that borrowers can do and how you can help them, there are a couple of points you need to make sure that they understand. When they're going for a loan, we're going to look at their credit, we're going to look at their income, we're going to look at their assets, and we're going to look at the value in the house itself. Each one of those points has many sub-layers to it that can either make or break the deal for you. But what you need to explain to them that going through the process, we're going to look and take a snapshot photo, if you can imagine this, of their life today and where it's been for the past 2 years. So we're going to look at their credit score. We're going to go back and analyze the last 24 months of that credit to make sure we have a valid credit score. And we have explanations if there happens to be any derogatory or slip-ups in their credit. Now you can have a very good credit score and still not be approved, because there can be things that are not making you eligible for the type of loan you're coming in. Even though your score is eligible, the score is not the only thing we look at in credit. And that's something I think we need to let the public know. Just because you go out and pull a credit score from a free credit reporting agency or an internet agency that you pay for, that is not your mortgage credit score, and that needs to be expressed when you're out there. I think it's very important that they get a credit report pulled by a reputable lender that's going to give them their mortgage FICO score. Now typically the mortgage FICO score can be anywhere from 30 to 50 points lower than what somebody may pull off the internet on their own. In addition to that, we need to talk about their income. We had a great example of somebody who told us what their income was over the phone, and based on what they said over the phone, they could more than qualify for the loan they were applying for. When they actually came in and met with the loan officer, we looked at their pay stub and realized that they must earn some type of bonus or commission structure on the way the pay stub looked. We further looked into their tax returns and realized they were writing off some expenses. Now he was a mechanic that worked at a shop. We would have never thought on the phone that he got paid commission based on the way and the number of jobs or cars he worked on. It turns out we were going to be okay with this loan because he'd been doing this for more than 2 years. But possibly you could have somebody who just switched jobs or just started, anything along those lines, and doesn't have a 2-year history, and all of a sudden you may get 2 weeks into this process and all of a sudden the lender sees this and realizes it. It's important to make sure that everybody sees all the information up front. The difference between a pre-qualifying phone interview and an actual sit-down or reviewing the actual documents is critical. I would suggest that everybody has their 2 years worth of tax returns together, everybody has their W-2s or K-1s if they have multiple companies, and a current pay stub together, and provide that to the lender, or at least have it available if the lender asks questions before you make a full application with somebody. Now we can move on to the assets, and everybody thinks this is a simple thing. I have the down payment money and that's all that matters. It's not. Different loan programs require a different amount down, and also they require different ways if there's gifts involved or where the money could come from. There's a number of people that say, well, I got the money from wedding gifts and things. This could be a problem because in today's society, we are so scrutinized with anti-money laundering, red flags, and all the fraud that's been in our industry for the past 4 and 5 years, or discovered over the last 4 or 5 years. It is very difficult to have a bank statement come in that has money being taken in as deposits that we can't verify. Anything that's in this loan file must be verified, whether it's a $500 deposit, whether it's a $300 deposit. If there's counter deposits, things that do not match up with the paychecks. Again, this can slow down the process. It can even kill the process depending on how large those deposits are and how frequently they are. Again, this is where your lender's going to come in, they're going to talk to your borrower, and they're going to explain all this to them. As the real estate agent, what I would advise you to do is have a broad overview of some things that could go wrong and things they need to be aware of. not to scare them, but to educate them so that they want to talk to a reputable lender that can help them through this, even if it's just a phone conversation, asking the questions we're talking about right now. The final thing is the appraisal. Now, the appraisal, hey, I'm writing a contract for $500,000, $200,000, $100,000. If it appraises for that, great. It doesn't quite work that way. We're going to scrutinize that appraisal extremely tightly. Now, what I mean by that is the appraisers are going to have 3 comparable sales, and we all know what that means. That's basically 3 sales, houses similar and like in size, look, structure, and have all closed in the last 6 months. But more importantly, we're also going to look for listings. What's the current market doing? Is it an upward trend or a downward trend? Does that property meet standards for the type of loan they're going for? A lot of times people may start out writing a conventional contract and it has to flip over to an FHA or government contract. There's different requirements, there's different things the appraisers have to do, and if we're not careful, the property may not meet those standards, and all of a sudden we have a deal that should go to closing, but it's going to fall apart because of the way we wrote the contract or didn't know certain things about the property until it was inspected. All of these things can be avoided with the communication and forthcoming from everybody, so that within the first 48 to 72 hours of writing a contract, 90% of this is covered and exposed, explained, and we move forward with going to closing. I hope these quick little points help you. Again, I'd like to thank you for joining me today. My name is Ben Blanks with Three Rivers Mortgages, Division of Hamilton Group Funding. I appreciate your time. Thanks again.